Hey, what's going on, guys? Welcome back to another video. Today's not going to be a trade recap. I'm actually going to stop those trade recaps for a while now. I'm going to be kind of changing the direction of this channel just a little bit. The reason to that is because I have been reminded, obviously through Keegan, but obviously through TikTok, YouTube, and in life in general, that I am still not profitable, okay? And I've been trading for almost 2 years now. I want to say I've really started to understand and really get into trading seriously for a year now. So in my mind, I still have one more year to go of like real life trading and real price action, and actually understanding the market. So I'm going to be taking a step back from posting mostly TikToks because those TikToks are used to promote what I do. But really and truthfully, honestly, like what I do is I trade fake money. The way I trade it is real, but I don't make real money. And a lot of people see right through that. So they're like, oh, I don't really care about how you trade or what this means because they're not really on my level. I don't want to sound cringe, but really they are not. They don't understand what's going on. And all they see is you trade fake money, you're fake, I'm not going to listen to you. The only time I'll listen to you is when you're credible and when I see that you make money. Thing is, with the stock market, it's pretty hard. It's not easy. And you definitely can get lucky, but I got lucky and then I got unlucky. So I got to work hard. And with that, I'm also like basically almost midway through my junior year. So I need to focus on my grades, on schoolwork and all that stuff, and focus on trades. And I can't be doing YouTube and I can't be doing TikTok. I'm mostly talking about TikTok. YouTube, I probably do here and there, recaps here and there. But what I'll mostly be doing, just a note to myself, is basically explain the models I have been trying to do, or explain my strategy. Because honestly, I don't really have a strategy. I for the most time, I enter off a lot of fair value gaps. Well, actually, it is a strategy that ICT mentioned. I think it says 2022 model of entering a fair value gap after like a PD array and a market structure shift with the OT and stuff like that. But a lot of the stuff, a lot of the time, it's just me drawing the OT and figuring out where the fair value gap is and hoping that price comes down. What I've really been trying to do now is drawing out the draw on liquidity. And I've kind of like started to like swing trading. At first, if you remember, back in my videos, I said that swing trading was dumb. You never want to hold a position overnight, over a week. A week is a little crazy for me, but a couple of days is fine because what you really realize is looking at the bigger picture. And I was talking to Keegan a few days earlier, and I saw that he told me he never looks at the monthly. And Keegan, if you're listening to this, you probably should, because the monthly, and actually this is more than the monthly. Like for example, the 3 month, the 6 months. Obviously, these are big time frames, but the big time frames tell you a lot about what's going on, right? A lot. Like you can see here, we're definitely in a bullish market, right? And then for 6 months, we went straight down and then we bought it back up. And now what do we do? Are we going back up to get these highs, or are we going back down, right? And there's still a month left to decide. So you look at the monthly and you can kind of tell, oh, are we bearish? Are we bullish? What's going on? What's the draw on liquidity for the monthly? And if you can determine that, then you can determine your draw on liquidity on the weekly, right? So on the monthly here, my current draw on liquidity is this previous monthly high, okay? And this was October, because now we're in November. So October's high and low, the low was made here in October, where this hit the fair value gap, the weekly fair value gap and weekly order block that we had marked out. We also hit a weekly consequent encroachment and a swing low right here, where price had a very nice reaction right off of it and started trading higher into Obviously, we've already traded into this weekly fair value gap, but it's now trading back into it, reaching for that draw on liquidity, which is the previous month high. So with that being said, I go into the weekly time frame, okay? And that tells you a little more. Now you can see that weekly fair value gap. You can see that weekly order block. You can see that weekly swing low. And you can see this weekly candle that we had last week. And this is really important. This was due to not only an absurd amount of news that came out last week. So this is last week's news. Absurd amount of bullish news that came out. Insane, with FOMC statements and an FOMC press conference. And tomorrow we also get, hopefully, bullish news with Mr. Powell that speaks tomorrow. And then on Thursday, we also have unemployment claims that comes out. And we also have, again, Mr. Powell that speaks at 2 p.m. So this might be a more formal conference. 9:15, this might impact the New York Open, but it might not impact the whole entire day in price action. And then on Friday, we have premium UOM consumer sentiment. So lots of news to look out for this week, right? But it was not as much as last week. So obviously with the monthly draw on liquidity being that high, we can now see that there's actually two draw on liquidities. The first one is being this, you can't really see it, but there's this swing high right here that was created off this weekly imbalance that came straight down. And this was after we hit this consequent encroachment. I can see it, but you guys can't with my trained eye, if you will. The consequent encroachment of this weekly fair value gap, this weekly imbalance that we have waked into, traded in the consequent encroachment, the midway point of this weekly fair value gap, and then we then sold off. And now in last week, we bought all the way back up. We traded into those wicks, and now what we're looking for is to finish those wicks off and to sweep those highs. That's my draw on liquidity. So you could take a swing trade for tomorrow for a couple days. Boom. Gets in tomorrow for FOMC, or I don't know. Yeah, could. Yeah, possibly could. Gets in. And then what I want to see is I want to get out of the market, and I want to see how price reacts around this range. So this is when I go to the daily, and the daily gives me a very nice draw on liquidity. And this is where I make most of my trades. And this is where swing trading comes in too. You'll see that you can see this monthly draw on liquidity is actually the swing high and not this one, right? But in that little area, there's this little gap where it's like, this is what I call like a price gap. This is also like buy side liquidity. It's a buy side void. It's liquidity void. There's price there between two almost equal highs right there. You know what I mean? Like right here and right here, almost equal highs. And that's where liquidity is gravitating to, but it's gravitating to the highest liquidity point, which is the swing high. And I also want to see, because it's almost got support from this 4-hour fair value gap. It's got consolidation, and then it moved up today, which I saw. I even traded today fake money. I traded a nice little long right off the open, worked out perfectly. Because I knew that draw on liquidity. I knew that we weren't going to get this draw on liquidity today, but I knew that we were going to get one step closer, and that's all that mattered. And I'll show you what I did exactly later in the video. But what I want to highlight and what I want to tell you is that I want to look for what happens next, because do notice that there's also a daily fair value gap in here that price could ultimately trade above this daily high, this swing high, monthly draw on liquidity, and tap into this daily imbalance to then reverse. And if we take a look at ES, sorry, this is a different chart color. I just couldn't change it. If we look on ES, I have all these lines drawn because that is institutional, that's engineered liquidity. That's what it is. So on its way up, people have their sell stops right here. And so that's what we're going to go take out when we hit on ES. This is the liquidity void I was talking about. This is the consolidation zone that we're in. And this is the void that we're talking about. ES would trade up. So we still have a long way to go on ES. We at least, I'm seeing either one full day, one bullish day, or 2 other days, if not 3 for Doji here, or, keep going. But I do want you to realize that this is a very, very bullish market that we're in right now for this whole week and last week. This was very bullish. There was not a single bearish closing candle. There was not a single bearish price action this whole week or this past week. This is bullish. But my question is, for how long? That's the real question. For how long are we bullish? Are we bullish forever? Are we going to take out all these highs? Is this the very last bearish run, or are we going lower? And if we're going lower, I want to catch where it's going to draw off. So my idea was this high, but we just ran through this high. So now my very last defense would be this swing high and possibly this fair value gap here. But the only problem I have, and this is what I would hate to see because ICT taught me, is if we close above this monthly swing high, which is probably better to see on SPX actually. If we close above this monthly swing high, this means that, to me, it just shows premium bullish price action, which means that we will close so high above this swing high and buy side liquidity that price is like we didn't even react to it, which means that we don't get affected, which means that we're not going to go back down. But if I see a close under this swing low, and then the next day I see like a doji, or the next week I see a doji candle appear, then I might be looking for shorts to the next interested fair value gap for maybe a one take profit. But my initial or my final take profit would be down here. I would be in a swing trade for weeks, maybe 1, 2, maybe 3 weeks, if possible, right? And so that's what I'm looking forward to is swing trading. But swing trading, again, with options is the most riskiest thing you could probably do. Trading options is risky as itself, but swing trading an option contract, even though the delta and the theta might not get affected as much because of how big a contract it is, it will still get impacted. So if you're in drawdown for more than a day, you're going to be in drawdown for the whole week. And your contract is going to be worth nothing if you don't time it right? Time and price is the number one thing I look for too. Time and price. Is it the right time to buy it, and is the price action the right? So that's that for the bias. With today's bias, we can draw down into the 4 hour and we can notice. Let me just mark it out real quick. So this is Tuesday, so opening on Monday. Where was Monday? Monday here. Draw a black line, dotted line. So we'll do dashed. We'll do Mon. Why the fuck is it like that? Why is it? Am I tripping or? What the fuck is it? Why is the font like that? What the fuck? Yeah, that's weird. And then you have, where's Tuesday? Tuesday right here. Tuesday. Okay. And then you have Wednesday would be here. Okay. So on the 4 hour, what you can notice is, well, actually we'll draw even more for this one. Actually, no, never mind. So over the weekend, actually no, on Friday, this was Friday after market. Friday market. Yeah, that's right. Yeah, Friday we had that last bullish run into that fair value gap, and we ended the day right about there. And what we created was a 4 hour fair value gap, which I marked out. And do notice, please notice that there's more fair value gaps down here. There's one here, there's one here. There's a bunch. There is a bunch. Like to naked eye, you can see a lot. 1, 2, 3, 4, 5, 6. There's a lot of fair value gaps that was created here throughout the week. But guess what? I marked out the closest one to where price would be consolidating. Because if the price action that you see, and if price wants to come higher, why would it go down so far down here to like this fair value gap to then come back up? It wouldn't make sense. If it's already up here and it did all of this work last week, why would it lose all of that for next week to then buy it all the way back up for the third week? That doesn't make sense. If it's really bullish, what it will do is it consolidate. It will use whatever fair value gap it is, and it will, like, look at this weekly fair value gap. We don't even close. Look at this. We don't even close. We don't close under it. And the fair value gap that's closest to this is the 4 hour that's created here in blue, and price consolidates here. As you can see, it's consolidating, right? Monday we consolidate. Monday price action was shit. Some people traded this. You don't trade Mondays like this. This is, after a big move like that, you're not going to see another big move. It's got to come back to some kind of support. So Monday was open, orders get filled. Yes, we come down, but we come down to what? Nothing. This is a fair value gap. We don't even get near this weekly fair value gap low. And then, we come back up today, and today we had this bullish advancements upwards, right? And so where was our draw on liquidity? Now, this was a little crazy. I didn't expect this to go so high. But what I had, oh shit. Yeah, I do have kill zone. 30 minutes. This is where I have my kill zone. So when I'm looking at the chart, I mostly figure out what is the daily high and what are the draw on liquidity for the daily. Obviously, if you look at the dailies, okay, today was that, but the previous day high was here. So if we mark that, previous day high was here. I can mark this in maroon. Okay, so that was the previous day high. Let's go back to the 30-minute. And as you'll notice, this previous week high is this one. That was the previous week high. That's the high we made right there. So I'm going to delete this, and I'm going to mark my previous day high, which was also, if you note, the New York high. Okay, so boom. That's our drawn liquidity. Okay? Why is that our drawn liquidity? Why wouldn't it be these previous day low? Why wouldn't it be the swing low? Well, it could. I mean, you could easily mark it out like this. Oh, here's our draw on liquidity here too. But what are we again? We're bullish. We're bullish. And maybe you're bearish. And if you're bearish, you would have lost and you would have realized that we're not bearish. But if we're bullish and we see bearish price action come down to bearish price actions and bearish PD arrays, then you don't trade. If your bias is that you're bullish for the weekly, then you don't trade bearish price action on the daily. Does that make sense? You could if you're really expert, but for me, I wouldn't. So my draw on liquidity would not be this. And as you notice, when you have your kill zone, I will repeat again, New York is red, and this is like highs and lows for opening ranges, and then Asia is white, and then London is green. The London is probably the most important here for New York session because it's the closest. But today, as you can see, Asian and London highs were both equally high, basically equal highs, okay? And the London lows got taken out at 6:30 a.m. Boom, that gets taken out. That hits an order block. That goes up. Okay, so right off the bat, we're bullish pre-market. This is pre-market. We're bullish. Consolidation. Actually, this is marked right here. Perfect. Consolidation. Then you have manipulation. And then you have distribution. Does that make sense? Consolidation in this range. Then you have manipulation down in this range. And you have distribution up. Okay? That distribution takes out Asian highs, London highs at 8:30. 8:30 we close. Do we see a reaction down? Yes, we do. It trades back down, but it gets traded all the way back up. Gets traded back up to what? Our first drawn liquidity, which is this swing high. This point of liquidity that was taken out. And I'm guessing right here is when we open. Yep. Because see that big move, and I watched this live. So we take this out basically pre-market. Not pre-market. This was basically market open. We take this out. Boom. ouch, that hurts. But we don't come back to this swing low. We're not coming back to this London sweep low. We don't come back to any of these lows. We come back to this 4-hour fair value gap that we tap into. Okay. So after this, what's your next draw on liquidity? It would be this swing high, the previous day high. And if you're smart like me, your ultimate liquidity would be this one, the previous day high of the previous day high, if that makes sense. So if you guys are that dumb, this high right here, because this, the previous day that we're in, it's called consolidating, because this day right here did not trade above this high, nor did it trade under this high. It just stayed in this range. So it's consolidating. So guess what price wants to do? It wants to break out because it's obviously bullish. We've closed above. So it's going to break out of this high's low, or this high, this previous day's high, this last week, this Friday, basically. Last Friday, my bad. Okay. 15 minute. So what was the trade? Watching this live, we take this previous day high right here. That was my initial target. Was this? No, this was in the 5 minute. I was gonna say. I remember this pretty well. So I had this fair value gap marked out. And so I was watching this candle live. So I was trading this live. We can turn this off. Drawn liquidity is still up here. We can still mark this just so you guys have an idea. So the draw on liquidity is that blue line, but that ultimate draw on liquidity is that red line. Okay, so that was the ultimate draw, and that's ultimately where we got. And I'll tell you how. Accumulation, which is that consolidation, manipulation to get out all these sell stops, sell stops, buy stops. After this manipulation happens, we get distribution, and we also get reaccumulation with redistribution, because we have that 9:30 open. So now everyone can start trading. So if we're bullish, we're in distribution. We're now in redistribution, reaccumulation, which means that there's going to be more buyers stepping in after this taps in. So what I wanted to see was this, not only take out this breaker structure right here. It's a little hard to see. I wonder if we could do on the 3 minute. This high gets taken out on the 5 minute, right? Gets closed above, and then we just keep trading higher. I was a little risky. I entered like around here. My stop loss, you know where my stop loss was? Right here. Behind the swing low, because if price was going to go back down after this closure, that means that we were not holding up to be bullish. Does that make sense? If we broke structure so high and we just wanted to keep going higher, my target was initially this. Fucking whatever, I'll put it here. Okay? Don't worry about the risk reward, the target, whatever. Like, that doesn't matter. What I'm catching right here is just a little glimpse of the actual move that happened. My last target was like up here. Okay? I could have left runners to go all the way up here, but there was no, to me, in my strategy and what I've realized that day, there was no draw on liquidity. There was nothing here drawn. There could have been. I could have gone way back, but this is way back. There's a 1 hour. Is there anything here, for example, that taps into price right here? Yeah, okay. Yeah, there's right here. There's an order block. Maybe you could mark that out. But is that really the draw on liquidity? Did I know that? No. What was the easiest thing that I could have gotten a trade in? Was that previous 2 days previous high that it wanted to break through, and that's exactly what happened. But I can't predict where that breakthrough is going to stop. That's what I don't want to predict. I want to know that, but I don't want to target that. What I want to target is where it's going to break through and get out of that. Now, the breakthrough, yes, and I could, fully get out of the breakthrough and notice that there's smart money here. But look again. Like I said, I'm in school. So this happened at, 10:55. The final breakthrough was at 11:40. I'm in classes during this. I'm basically going to lunch at this point. I'm in the middle of physics. I'm in the middle of English. I can't be watching the charts when this happens. So having the draw on liquidity set, having price, knowing where it's going, reaccumulation, redistribution, that to me was a successful trade. I didn't post any of this on my TikTok. I'm almost now staying private, if that makes sense. So that was the draw on liquidity that was marked today. Okay. And so for tomorrow, if you can expect, we're also expecting for consolidation. As you can see, there's obviously consolidation happening again. Hoping to see this consolidation kind of run out until Wednesday. And then Wednesday, we get in this fair value gap that has been created. Also on the 1 hour, we could probably see this on the 4 hour. 4 hour, there's a little bigger, there's a bigger gap that was created on the 4 hour. If you notice, right, let's actually delete all this because I don't need. There was also a gap right here. Okay, let's mark this. And on the 1 hour, if you're really paying attention, there was this gap right here. And we could just mark this in orange, right? That was traded into, but not fully closed under. So now you're asking, okay, well, now that you took a trade today, will you take a trade tomorrow? Guess what I'm going to say? Nope. 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 Not when Mr. Powell speaks at 9:15, 15 minutes before the market open. Hell the fuck no. The market's going to go up, then he's going to speak, it goes down, and then market opens, it's going to go up, then he speaks again, it's going to go down. And then your orders are all over the place. Your option contracts are getting fucked left and right. And you're over here saying why? You're down 1,000 and then up 4,000 and then down 4,000. So for me, it's a no. Could I trade? Yes. Could I have my bias right? Yes. Will my bias be correct? Yes. Yes, it will. What is my bias? My bias is that we target this previous month high with this consolidation and buy side void happening right before it. That's my target. That's my bias. Same thing on ES. That's the exact same thing that's happening. I'm just targeting this liquidity void, not really worrying about what's up here. Again, if we do reach what's up there, that means that I'm out of the market and I do not want to trade whatever happens next because I'm bearish for the monthly. Even though it shows bullish price action, I'm bearish. I'm hoping that this sells off. It taps in and then it starts selling off. Because this is all, like, if you can't realize, this is all manipulation. This whole move is manipulation. This is all manipulation to get higher liquidity, to ultimately come down. All manipulation. NQ, like I said, a manipulation. And this is actually a pretty good example for NQ. This was mentioned a couple of videos ago. If you watched my videos a couple of weeks ago, this manipulation move was going to run. Let's go on the daily. It's probably more accessible here. We have accumulation down here, right? That happened after we tapped into this fair value gap here. Perfectly tapped into it. Accumulation, and then we have that distribution. And the accumulation is probably like down here or some shit. Didn't really get that right. But the manipulation is definitely right. And what I'm hoping is that manipulation, you see how it stops here, is because I'm hoping that that's where it sweeps this monthly high, and gets out. Because on NQ, if you notice, and I didn't mark this, but I'll mark it for you guys. On NQ, we can see that there is that fair value gap that was on SPX here. This gray fair value gap is actually this NQ fair value gap right here. So if price ultimately wants to sweep this high, it will go higher, but it will not go through this fair value gap. What it will do on SPX is probably hit this fair value gap. It will trade above it, but it will not close into it, nor will it close above this monthly swing high. And if it does, I'm out for SPX. I want to see what NQ does. If NQ shows bearish price action, because NQ usually gets the price actions before SPX or any S&P 500 companies. NASDAQ is a little faster on that. I'm pretty sure it has more volume to play with, so it's definitely more volatile. So it's definitely in that range to hit that. And so after manipulation, we get distribution. And so like I said with ES, is that there's engineered liquidity that was created for sell stops. So, no, for buy stops, my bad. Wrong con. So I'm hoping that distribution, I can catch the top and sell at the bottom. And this would be, this would be like if I put $100 here and I just wait a whole week and it just, my contract, gets filled, then this would be the play of the year for me. But I want you to just take a look at just the daily history and the trends. The trends are a huge help too. You have huge move up, and you have a big move down. Then you have a pretty big move up, but it doesn't get like to the halfway point. It stops at some kind of big fair value gap, right? The only visible fair value gap here is this one on the daily. Stops at the consequent encroachment, comes way back down. Where does this move up stop? At the visible fair value gap right here, the very last one. Boom. This one. That didn't even get to the consequent encroachment. So this shows that it doesn't want to trade higher. So it comes all the way back down. Sweeps all these lows. Gets all the way down. And then what happens? Manipulation. Price does not show, like look at these. When it goes down or when it goes up, this one didn't show anything. But when it came up, you see it down a little bit, up. But not for long. This only stayed like maybe half a week. Maybe a full week or so. This was just straight bullish week. This is just straight bullish news. Straight manipulation. So is the manipulation really ending higher? Are we just going all the way higher? Or are we turning at one point around this highest fair value gap that was marked here and rejected here? Are we rejecting it again and going maybe a little higher to sweep and then come back down? Or are we really just pushing straight bullish? And if that does happen, then I'm looking for drawn liquidity to be bullish, because I'm not predicting what the market will do in 40 years. To be honest, I don't really give a shit. I just want to make money. And predicting the market like I'm doing right now, like I don't want to say, oh, I'm hoping to see this. I'm saying if the market does that, then we see this. And if it doesn't do that, then I do that. But I'm not saying this candle will be exactly here at this time. That's not what I'm doing. Did not get to do QQQ. Let's see if there's, yeah, okay. QQQ, this is kind of what I'm noticing too, is this is like on the weekly, we have like consolidation, like kind of all consolidation right here. It's like in the same price range, not really breaking out. I mean, the only time it broke out was like these lows. Consolidation, and kind of like the ultimate goal, or the ultimate like endpoint that I don't want to see is trading above, is this the monthly high? Yeah. QQQ is getting there. QQQ is almost there, actually. So the monthly high, previous monthly high is right here. And this high is what I don't want to get taken out. Because if we take this out or go forward, right, on QQQ, if we break this high, which we are most likely to, our next draw on liquidity would be the next swing high, which is here. And if we break that one, then we can see a very bullish run up. Right? Who knows? You can't predict the market. Yeah, I mean, like, we've already basically tapped into it. It's very obvious tomorrow what will happen on SPX. I theoretically right now I could have a swing contract and I could be winning. Theoretically, if I put in $100 yesterday for a swing contract for maybe 3 days, I would be up right now, a lot of money. And that's what I'm planning to do, because to be honest, the strategy now, I think it's easier to swing trade than to day trade. Because the thing with day trading is what I'm realizing, there's so many strategies going against each other. You have ICT, you have order flow, you have trend lines, you have support and resistance, you have all types of ICT merging with other shit. There's just a bunch of strategy, different terms, different terminology, different ideas, different theories. The one I've recently heard is the quarterly theory, right? I mean, I get it, like that's all pretty nice, but the shit that is being like, it's very intriguing. Like, don't get me wrong, it's very, very intriguing, interesting, and smart. And when you read about it and you learn about it, it makes sense. Everything's, quarterly, it makes sense. But there's just so much. Why can't it just be, where's the next draw on liquidity? Where are we going in the next month, next week? I mean, theoretically, if you think about it like this, and here's how I like to think about it with swing trading. If every day you day trade, every single day of the week you day trade, and you make $100 every single day, averagely, why couldn't you then enter a position on a swing trade on a Monday and exit on a Friday? And that position makes you the same total as you would if you were to day trade every single day. Does that make sense? If we look at the weekly, and this is understandable, some weeks like this, for example, trade up and then trade down. So theoretically, when you opened up your position here for calls for that draw on liquidity, you should have known that it reached some kind of confluence area and your calls should have been liquidated or taken out, or you have reached profit at that point. You shouldn't have held for the whole week. But hence why you do your day trading analysis to know what the draw on liquidity is and where it might potentially reverse. Because if you're really that, if you understand it so well, right, isn't the potential way higher to swing trade than to day trade? Because theoretically, the weekly is always moving towards where the monthly wants to go. And the monthly is always going to, it's like that. And the only time that the daily will disrespect the weekly is to get liquidity. Right? If the weekly wants to go higher, the daily will go lower to grab sell side. And that's fine. That's understandable. But in general, the weekly is going to be bullish. If it's in a bullish trend, whatever, this and that, bullish PD arrays, smart money, whatever. Right? So that's something I want to try, because swing trading, not only does it, I want to say it definitely adds risk to your mind, to your body, right? When you go to school and you know that you have $3,000 sitting right there and you are just sitting in class, and at any time anyone in the world can say something or do something and it can change your position in a matter of seconds, that's scary. Yeah. But again, that's the risk you take for holding that position for so long. And the other risk is holding an options contract. I'm starting to think that, or starting to do it with options, right? If you were to swing trade with stocks, that's a different story. Because as I've seen in my stock market game, actually we could check that out right now. I'll show you guys. On Market Watch with my investment society, as you can see, there is we're trading stocks and not options. And so right now I'm up 15 grand, but today I've lost almost 4% of my account. But I want to highlight Keegan McClure here. Pretty sure yesterday he was down 60 grand. Hence why that negative 300%, because we started off with $20,000 or $10,000, I think. I think it was $10,000. And so he was down 60 grand in stock assets, and now he's up almost $9,000 in a matter of 2 days. That's because he held his position and did not sell it. But if you're down 60 grand on an options contract, that would be a different story, because it's obviously how you pick. Let me I wish I could explain it because I personally don't understand how options contract move. And I'll be honest with myself here, and I'm being honest with you guys. The delta, the theta, the volume, the strike price, all that stuff, I've understood a little bit. But the fact that like there's so much to go into, I know the date of expiration is a big deal. So 0 DTE is very, very important. That's very risky because the contract ends that day. So the contract is more volatile, right? If that makes sense. It's very, very volatile. And the more volatile, as you can see here, let's do here. Let's do like all, for example, so we can see all these, right? So we're on SPX here, and let's say I want to go calls for tomorrow, right? And I can see this is what you would normally see, right? When you have all of it, you can see both, but I'm going to do calls. You got 0 DT, 1 DT, 2 day, 3 day. And this is when your contract expires, okay? This also tells you when the contract expires. So today we are November 7th. And so in 10 days will be November 17th, right? So if theoretically I want my call option to end in 3 days, I would say from tomorrow, right? I want this to be 3 days. So probably want to do, I don't know why there should be 4 days here, but you probably want to do something around 4 days for tomorrow. But let's say we were 9:30 today. So 3 days, boom. You open 3 days, it's calls. So now you have your bid, you have your ask, you have your last price, you have the change in the option contract. So some of these don't even have a change. Some of them do, some don't. Implied volume, and then you have your delta, gamma, and theta, right? So on these bigger contracts, there's not a lot of movement, but because these are 3 days out, if you go to the 0 DTE, you're going to see a lot of movement down here on these bigger contracts where you can see the percentage. I mean, some of these contracts are moving, as you can see today, everything's going to be bullish. Everything's going to be bullish, right? And this depends on where you buy it and when you buy it, right? So let's go back to this one, 3 day. So let's say, for example, I don't know if I can even do this. More paper trading. Okay, so notice how this is different from this, because this is live. This is why it's purple and it's moving. Paper trading, it's not live, or it's live, but I'm pretty sure it's down. No, never mind. So if I wanted to buy something 3 days out for a contract, what I would look for is, I don't really know. I just pick it. But my range, right, if my account, let's say is, I don't know. Oh yeah, there's one thing. This is like out of the money. This is in the money. And so what Keegan told me is if you buy a contract that's out of the money, that goes into the money, you make a lot of money. But if you buy something that's already in the money, that means you're already making money. The contract is already moving. If you're out of the money, you have a possibility that you go into drawdown easier. Also, in the money is also way more expensive. As you can see, these prices, this is like $5,000 to buy, like right here. If I buy this, this is, how much is this? How much would this be? What the fuck? Where the fuck did he go? The fuck? Can I put it on the fucking side? It would be $8,000 just to buy one contract like that. So you can see that these are very expensive. When you go out of the money, let's just close this. When you go, okay, so let's say, yeah, I've today's trade was almost $8,000. But that's because I put almost $10,000 into my account. So I basically did half of my account. But let's say I want to be a little more safe and less risky. I would put $5,000 in my account, or maybe less. Actually, maybe let's put $3,000. So in $3,000, right? This is $3. This would be $300, right? So in reality, you would, if you want $3,000, you'd go into the money because now you go in the money. But you want $3,000 in how many contracts? Then that's the next question. How many contracts do you want? So what I typically do is I do 3 contracts, and that would be 2 take profits, 1 runner. But if it's a very short move and I need this in and out, I would do 2 contracts, 1 for the big move and a tiny one that I will leave as a runner. And if it doesn't, go for a runner, then I will call it a day. So if I want 3,000, then I'll look for something at like 1,500. Okay. And this seems to be adding up right here. So 1,500, and then I say quantity 2, I would need 2 of them. That's 3,100. I would buy this. I want to buy this contract. Single option. Yes, it is. Make sure it's SPX. This is the strike price. This is when it ends at 10. The limit order, market limit. Market is better because it just buys it right now, and I just place my simulated order, right? And so now what I've told the market is that I just bought, and this is the contract option here. You can see this isn't the chart. This is the option contract, and how it's doing pretty good. And that's how you do options basically. But my final point would be that option it's very risky. It's definitely more risky than anything. But I will put this on myself that I will try to swing trade, and I will try to I will try it out. I want to see how it goes, and yeah. So I will see you guys in the next one. Peace.